guys, on today's episode, we're going to talk about a very exciting subject, life insurance. I know, don't throw the baby out with the bathwater on this one. What I have seen over the last few weeks is folks bringing in force illustrations of a financial product that just doesn't work for most people simply because of how they've been taught to fund it. So you want to pay attention in this podcast today. It's a really good education on how this specific product called Index Universal Life works. And we're going to break down a specific illustration, an in-force illustration that we've redacted the policyholder's name, we've redacted specific policyholder information, but it's a really good podcast, in my opinion, that's going to help you understand the do's and don'ts, the buyer beware of how you buy permanent life insurance. Hey, like always, if you like our content, please let us know. Hit the like button, hit the subscribe button, and tell your friends. Hey, we'll see you on the other side. Thanks.
180 and we're at the speed down to 2,500.
Point wherever you reduce speed to 180.
Blackbox. Hey gang, welcome back to KP's Blackbox. Today we're going to go a little off the reservation, which we do that a lot. We're going to talk about specifically something that's been coming up, Isaiah, over the last probably 4 or 5 meetings, it seems like. We've had our prospects and clients, or we're onboarding as new clients. We've had these folks come in with a specific financial product called Index Universal Life Insurance. And today I'm going to do a podcast where I'm going to be a little bit on my soapbox and show an in-force illustration of one of these folks specifically, and obviously we've redacted their name, we've redacted every bit of information that would show them personally because we're not here to disparage or hurt anybody's feelings. And the consumers, unbeknownst to them, have a financial product that's not anywhere near performing the way they were told it would, or the way that it was even illustrated. And the reason I wanted to bring this back up and publish this in a podcast is I see this, you see this, day after day, year after year. We have people come in with their hard-earned dollars, putting money into financial products that just won't perform. Now, I'm not making a blanket statement today that all Index Universal Life is bad, but unfortunately, the overwhelming majority of the financial products that I have seen come through our office from other advisors and agents that consumers have brought us, would you agree the overwhelming majority of those have been substandard at best?
Absolutely.
The overwhelming majority, let me just call a spade a spade. 100% of the illustrations that folks have brought me so far, every one of them shows that the client's policy is going to lapse somewhere in the near future. If not in the non-guaranteed columns, absolutely true in the guaranteed columns. And we're going to hope to demystify and break this down for you today using a real-life in-force illustration. And maybe we could call this episode Index Universal Life, Buyer Beware. Now, no disparagement to Index Universal Life or to companies that issue these contracts, because there are instances where they can work and where they can benefit the consumer and be a very good financial product again, housed within a well-diversified plan.
Mhm.
We talk about that. We preach that. We make that our stance in our philosophy of our firm. That even though I love max-funded permanent life insurance, I love whole life insurance issued by mutual companies, meaning you participate in the profits and the dividends of that company. Now, there's going to be haters out there that say, oh, whole life is also bad too. You're right. Some of it is. And some of the products in the marketplace is not suitable for your worst enemy. So today we hope to demystify and educate you. And if you're watching this and you want to know more, maybe you've been issued one of these policies and you would like an unadulterated, real analysis on how it's performing and whether this is going to happen to you, that's going to happen to this specific client here who came to us with this product, reach out to us. We'll give you a absolutely no obligation consultation on whether or not we see the product that you have as a viable insurance product moving into the future. And I think one of the things to also reiterate here is that insurance is not an investment. Investments are not insurance. They don't play in the same universe in the aspects of what they do or what they're designed to do.
Yeah, let insurance be insurance, let equities be equities.
Yeah. But if you can complement one or the other, there's some science, there's some economic science behind this. There's some great educators in the marketplace. Dr. Wade Fowle, Dr. Jamie Hopkins at the American College for Financial Planning. There's been great publications on how these products, specifically IUL, how plain old dividend paying whole life, can be an absolute complement to your investment portfolio and should be considered in how actuarial science should come together with your investments. Actuarial science, your insurance products, how they should come together with your investment products, stocks, bonds, mutual funds, ETFs, alternatives, and everything in between. So our objective today is to educate, and some of this will have my personal opinion and my personal money philosophy built into it. But we're going to also let the math do the mathin', right? And some of the stuff you're going to see in here today just doesn't math. And it's fuzzy math at best that confuses consumers and sometimes even confuses guys like me who's been in the business for 30 years, primarily helping people on the transfer risk side, focusing on the insurance side. And I've seen some really bad, I would almost state as inappropriate. And it's just important to educate yourself. So hopefully that's what we do today. Like all podcasts, though, we always want to start by saluting those who are important to us in our firm. I would say, I need to go back and look at the stats on this, Isaiah, but I would think our current client base is made up of 60, maybe even 70% of our client base has some military affiliation, if not more. It might be upwards of
And first responder.
90%, yeah. And a lot of first responders had
Military
a
experience.
military experience. So a lot of people that we interview in our podcast have had some military background. They've gone on to be an entrepreneur or gone on to be, a person in the community that's has a business aspiration or business goal to do something greater than themselves. And we love interviewing people like that. And we find a lot of times that their military career had a major influence on what they're doing today or the business philosophy that they uphold today is grounded and rooted in their military experience. So we always do a toast. This year through May of 2026, we're toasting Four Branches bourbon, and we've got to get our replenishment here, Mr. Underdown. Cody, let's call Harold today. Cody's in the control room, if you guys don't know that, when I'm talking into the atmosphere here. Cody and Jacob. We need to let Harold know that we're running on thin air here with our Four Branches supply. But as I've stated in past podcasts, Harold got the honor of having Four Branches as our main bourbon to toast because he did a blind taste test in front of all you guys back in the summer and got Four Branches right. And not only got that one right, but he picked the other ones. And we tried to throw a little curveball. I shouldn't say we. Jacob brought some scotch out to try to throw him off. He picked that one out immediately.
Was it a curveball or a layup?
A layup, yeah. Maybe it was a layup you gave him. But at any rate, shout out to Four Branches. Any veteran who comes in between now and May and does an interview with us signs the Four Branches insignia here, and then we're going to give this away at one of our summer events and auction it off and give the money to charity. So if you know anybody who's a veteran who's moved into the business space, let us know. Reach out to us. We would love to have a conversation with them and maybe publish that on a podcast. So all that being said, thank you to our vets. Thank you to our active duty, the Gold Star families, those who are serving, the moms, the dads, the wives, the brothers, the sisters who are in the rear with the gear while your loved one is forward deployed. We thank you all. Toast to you. We throwing it back?
I guess.
Whew. Did you hear that? Did that come through the mic?
Yeah, I did.
Had a little, whoo, got me. Yeah. So, all right, let's dig into this. We got a little while. This is going to take a few minutes. The illustration that we're going to show you today, first and foremost, if you have life insurance, and it's cash value life insurance, or what we would refer to sometimes as permanent life insurance, it's important every year, in my opinion, my professional opinion, would be every year you should ask for from your agent an in-force illustration. Now, for our clients, we volunteer. We give it up front. We go, hey, you should take a look at the performance of your insurance contract year over year over year. And if you're funding traditional participating or dividend paying whole life insurance, it's kind of going to be like watching paint dry. There's not this exciting up and down of the market. You're not indexing the return inside your life insurance contract to any index if it's plain old dividend paying whole life. It's simply based on the performance of the insurance company and their general accounts and a credit of those profits that they've earned back to you in the form of a dividend. Now, any insurance company worth its weight in gold, they should have always paid you a dividend. Although they're not guaranteed, every mutual company has that as a goal. I can tell you that because I've worked with dozens of mutual companies, and there's probably only 5 today that make my list of saying these are companies that I would want to represent to my clients. And if you want the short list, I'll tell you that today. Number one on my list is a company based out of Philadelphia, Pennsylvania, Penn Mutual. Shout out to Penn. Next on that list would be Mass Mutual, Massachusetts Life. Northwestern Mutual, and much respect to the folks at Northwestern. Northwestern typically only issues their contracts through captive agents, meaning only a captive agent or an agent that's represented or employed or contracted with Northwestern can represent their products. But it's still a very, very good whole life product. Next on the list, I would say, is probably Guardian Life and New York Life, and a little Western Southern company called Lafayette Life, which is a mutual holding company, but they still pay dividends to their policyholders. These types of mutual companies, as far as the research that I've done and been able to look at, they've never missed paying a dividend to their policyholders in their corporate existence. And there may be a couple in there where there was some structural changes in the corporate entity itself where that may have not been true in 1 or 2 years, but without a shadow of a doubt, Penn Mutual has never missed paying a dividend to their policyholders. I think Mass can boast that too. So when you see an illustration that has guaranteed and non-guaranteed, it's going to be important to understand what those mean based on the type policy you have. Today, we're specifically going to talk about index universal life, which is not a whole life product. Whole life in and of itself is not indexed to any exchange traded fund or indexed to any mutual fund. It doesn't work that way. Whole life is strictly based on the profits of the company and you participating in those profits in the form of dividends with the company itself. Dividends are not guaranteed, but again, if you go back and look at the history of those top 5 companies I talked about, you'd find that it's pretty normal to see a dividend. It would be abnormal to not see a dividend, in my opinion. But today, we're specifically going to talk about index universal life. Today, we're going to pick on a specific company that just happened to be the last 4 illustrations that I've seen has come from this company called Transamerica. Now, I'm not here to disparage Transamerica. Very good company, highly rated. They're a stock company, which means they issue their profits and their dividends go to who, Isaiah?
The shareholders.
The shareholders get their dividends and get their profits. And over the years, many companies like Transamerica have demutualized and they have become stock companies, which means they issued stock to the public to raise capital to be able to grow their enterprise and grow their business. And the reward for growing the business and for being profitable is they give you growth in your stock and potentially a dividend if they declare a dividend. But it goes to you as a stockholder, which means you have to own the stock to get the dividend. Make sense?
Yeah, usually when you see someone switch from growth to declaring a dividend, the company is declaring that, hey, we've hit our max capacity for growth, we're where we want to be, and to reward you for participating in their growth, they pay you a dividend.
Perfect. That's exactly right. So what I hold in my hand today is what's called an in-force illustration. Anytime we have a client or potential client come into our firm and they have permanent insurance or cash value life insurance, we ask them to always go get a current in-force illustration. So this particular person brought me their in-force illustration from Transamerica. This person bought this specific policy, I believe back in 2011, when this client was 31 years young. And they bought a face amount of $605,000. So that's how much death benefit they wanted. I'm not going to get into the details of how they came up with their death benefit amount. But more importantly, that they bought this death benefit for $605,000. And in a index universal life contract, this policy value was going to be level, meaning the death benefit. And what I mean by level is that that policy death benefit will never increase. There is a way for it to go down in value all the way to zero, but there's no way for it to increase based on the indexing or death benefit option that they choose. And there's usually two. You can choose option A or you can choose option B. Option A is usually a level death benefit. Option B is an increasing death benefit, or vice versa. Option A increasing, option B level. So this particular client didn't really choose, the agent chose for them. They said, hey, we're going to choose a level death benefit. And because they didn't really have the acumen to know the difference, they just said, okay, fine, let's choose level. Anytime you get an in-force illustration, it's important to read the document. So guys, why don't y'all bring that up on the screen and we'll start to kind of dissect what's happening here. So this is the front page of an illustration. So when you're looking at this, what you can see here in bold black ink, it's going to say, this is an illustration only. An illustration is not intended to predict actual performance, interest rates, dividends, or values that are set forth in the illustration are not guaranteed except for those items clearly labeled as guaranteed. So it's important to understand that what you're going to look at in this document is a projection of what they believe could happen, but not necessarily going to happen. So when you're looking through an in-force illustration, it really is important to break it down, to read it, and to understand what's being said to you. And so here they're saying, hey, if you own an index universal life insurance contract, an insurance contract, the first thing we see here, Isaiah, is they go, clearly, this is not being published as a security. Okay, this is not a stock, it's not a mutual fund, it's not an ETF. And index universal life insurance policies are not an investment in the stock market or any index. The index account interest is based on, in part, an index performance of which it's going to mirror.
Yep.
Is the best way I've heard to explain it. Would you agree?
Absolutely.
Here's an important one. Past performance of an index is not an indication of future performance. We say that to our clients all the time. We can go back and show them, like in the investment world, when you're managing investment accounts, Isaiah, past performance is never going to be indicative of what the future will tell us. It can leave clues, right? History doesn't necessarily repeat itself, but history can leave really good clues for what's going to happen, right?
Absolutely.
So this goes on to say, additionally, there's no guarantee that the company will declare an interest rate greater than the guaranteed minimum interest rate for the basic interest account. What the heck does that mean, Isaiah?
Yeah, so what it's saying really is it can't exceed the minimum interest rate. So you can't decrease below the guaranteed minimum interest rate.
Okay. So in this particular product, what did they set the guaranteed minimum interest rate at?
1%.
1%. So most people would, man, you look at it and go, the worst I'm ever going to do, you're telling me, is 1?
Yeah.
And they go, contractually, you're exactly right. The worst case is going to be 1. So what would be the best case according to this illustration?
The best case would be the current cap rate. So cap rate means when you have these underlying indexes inside of these insurance products or in other insurance products like annuities, you have what's called a cap rate. So when you have a cap rate, they'll usually declare a rate, and that could be anywhere from, I've seen it at 5 all the way up to 9. So what that means is,
Or it could be higher than
it could be
9.
higher. But if you have an index that's mirroring, let's say there's the S&P 500 like this one is, at the S&P 500 does 9% for the year, your account's going to be credited 7.5%.
Okay.
That's the end. That's the most your account value is going to grow by 7.5. But if it goes down to negative 7.5%, this is saying here they're going to get a guaranteed 1%, no matter the performance of the S&P.
Okay. And we'll come back to that in a second. So, guys, let's go, guys, to page 2. So page 2 on the left side of your screen here basically breaks down in a basic life insurance illustration. What the insurance company is doing in an in-force illustration is they're telling you what product you bought, which is at the top left there. This is the WRL Freedom Equity Index UL on form EIUL 010305. That basically stands for Equity Index Universal Life. This is probably their first rendition and maybe third or fourth or whatever variation of it. I'm not sure what those numbers in their company really mean. On an in-force illustration, it's going to tell you in the top left-hand corner under that redacted bar, that black bar, it's going to tell you when you bought your policy and what sex you were. So this was a male, age 31, who was preferred at the time the policy was issued. Mm-hmm. Once you get issued a rating, the insurance company can never take that away from you.
Yep.
That's called a unilateral agreement, meaning only one person can make changes to the policy, and that's typically you, the policy owner. So this particular individual had a preferred rating, was 31 years old at the time he bought it, and he had a monthly premium that he, at the time, agreed to, which was $300 a month. And you can see that he chose a death benefit option of level, meaning that specified amount that he started with, $605,000. Mm-hmm. That death benefit was never going to increase.
Yep.
So first and foremost, when you think about that, if the death benefit stays level, what is it subjected to in the future? What could decrease the death benefit?
Yeah, absolutely.
Inflation.
Mm-hmm.
The purchasing power of your dollar reduces what the value of that death benefit will be in the future. So if it doesn't increase, it's stagnant, it's flat, which means inflation erodes the death benefit.
Yep.
So that would tell me that any cash value, any underlying cash surrender value, in order for that to be beneficial, what has to happen to your cash value?
Has to grow.
And has to grow past
Inflation.
death
100-year
benefit.
average at
Yeah.
3.3%.
to keep up with that value of your death benefit. So we'll come back to that. And then they're going to tell you there's some options in death benefit. You can increase the death benefit or you can keep it level. If you increase the death benefit, what do you think happens to your cost?
It goes up.
Right. So just remember that. If you take an increasing death benefit, your cost is potentially going to go up as
Especially as
well.
you age.
As you age, right. Important note, Isaiah, in IUL. So death benefit, this says the life insurance policy provides a level death benefit as described in the policy. The benefit is paid to the beneficiary upon the insured's death. The death benefit in this illustration is $605,000. The actual amount payable at death may be decreased by policy withdrawals or any loans that the owner took out. Or it could be increased by additional insurance benefits you purchase. We will, the insurance company, will adjust the amount of the payment in accordance with any attached rider, subject to its terms. the death benefit column shows the value if paid upon death at the end of that specific policy year. Then it's going to get into a few other definitions and assumptions. We won't spend the time on those today. But one I do want to pay attention to is called the minimum monthly no-lapse premium. So the minimum monthly no-lapse premium in this case, as illustrated, was $3,587.64. The minimum monthly no-lapse premium is the minimum premium necessary to avoid a lapse of the policy during the no-lapse period, regardless of cash value. So that's something we got to unwrap. Mm-hmm. The premium will be calculated for each policy issued. Policy and rider changes will alter the minimum monthly no-lapse premium. Under certain circumstances, extra premiums may be required to prevent lapse, meaning your policy canceling. So the no-lapse period in this policy, as we stated in this illustration, was between 0 and 60 years old, the lesser of 20 years or until age 65. As long as you pay that premium, it's not going to lapse. That $605,000 will stay in force. From issue ages 61 to 85, it's a 5-year no lapse. So we have to come back to that. So if you take the no lapse period, the policy will not lapse even if the net surrender value, aka your cash value, on any monthly policy date is insufficient to pay the monthly deduction due. As long as you pay the premiums, net of the outstanding loans or any withdrawals, meet or exceed the cumulative minimum monthly premium, your policy won't lapse. But if you take a withdrawal or a loan or increase or decrease your specified amount, the death benefit, you could potentially lapse the contract if you don't make extra premiums. So these are things you just need to pay attention to inside an insurance contract. Another important little note is that allowing the policy to lapse and terminate may result in adverse tax consequences. So what that means is that if you had a gain inside your policy and you'd taken loans out over the years, and then maybe the policy lapsed, that money you took out could be subject to income tax, even though you were told that the policy was going to be tax-free to you if you use the money. Mm-hmm. If you use the money and don't lapse, the contract should be the rest of the sentence. So that's an important one to understand and dig into the features and the benefits of your insurance contract. So the no-lapse guarantee, this is the payment of minimum monthly no-lapse premium, assures the policy will remain in force during the no-lapse period. The specified amount will be guaranteed regardless of cash value during the no-lapse period, provided that the cumulative minimum monthly no-lapse premium requirements are met. If you come up short of that, the bottom line is your policy is going to lapse. So let's go to page 4 and 5 now, guys. These are the key terms inside this person's IUL contract. There are basically 2 accounts in this policy. Yep. There's a basic interest account, and there's an equity indexed account. The basic index account is basically like being in the general account of the insurance company, and they're going to pay you a guaranteed minimum interest rate. That guaranteed minimum interest rate for this contract under the basic interest account is set at 2%. Mm-hmm. It says non-guaranteed interest rates for the basic interest account may be more than 2%. The interest credited monthly to the basic interest account and each of its segments may be credited with an interest at a different illustrated interest rate. Mm-hmm. So something to think about there, Isaiah. What happens if the Fed raises rates? What's going to happen to that basic interest account?
If they raise rates, it's going to go up.
That interest rate should go up, right?
Yep.
So the actuary at this insurance company or the portfolio manager, whatever they title that person who's managing these funds, if the underlying interest rates for the government go up, more than likely your basic interest rate should go up. For this particular client right now, they're telling them that rate is set at 2%. Now, interest rates have gone up over the last few years. It's interesting that that's only paying 2 when money markets right now are paying what?
Last time I checked, about 4 was the average.
It's almost 4%. So if you were going to have money in the basic account, you might as well just have it in a money market. So that's something to watch. The index account now, this is where all the salesmanship happens.
Mm-hmm.
The index account is the portion of the cash value that's credited with interest at a rate which is determined based in part on changes in the specifically the S&P 500 index, excluding dividends. So that's something we're going to have to come back and have a conversation about in just a few minutes. Each net premium or transfer into the account will be credited to a segment associated with the policy month in which it was received. The company is going to declare caps for each segment. We talked about those caps earlier. Right now in this contract,
7.5.
7.5 is the cap. So if the S&P does 10,
It does 7.5.
theoretically, they're only going to get 7.5. We're going to go back and look at a 20-year index of that here in just a second. So as we go through further into this, these definitions are basically going to tell you what all of these different things mean to you inside your policy. Let's skip down. Most people understand monthly deductions, surrender charges, cash values, net surrender value. These are pretty straightforward. Now, if you have a loan, the loan equals all outstanding policy loans, if any, and accrued loan interest. The loan balance decreases the death benefit. So if you take a loan from your policy, the standard rule of thumb is your death benefit is going to drop by the money you take out. So if you have $605,000, like in this scenario, and the client took out $5,000 in a policy loan, his death benefit is going to be what?
$600,000.
Exactly right. So a loan reduces the death benefit. General rule of thumb to remember. The amount of cash value equal to the loan balance will be credited with an interest at an annual rate of 2%. So policy loans are taken from the basic interest account first until exhausted, and then from the index account. So if you have no money in the basic interest account, they're going to go to the equity index account.
Yep.
But if you have money in the basic interest, they're going to take it from there before they take it out of the index account. The theory is why disrupt growth in the market? So policy loans, the maximum loan interest on an outstanding loan balance is 3%. Seems pretty fair, right? With a maximum preferred rate of 2.25 charged in arrears. The preferred interest rate is charged on amounts in excess of premiums paid, less withdrawals, and any outstanding loans, including interest. Preferred rates are available after the 10th policy year. So we'll go from 3 down to 2.25 after the policy's been in force 10 years. Mm-hmm. So that seems pretty fair. That's a pretty low interest rate to charge your policyholders. Mm-hmm. And when you borrow money from an insurance contract, Isaiah, are you borrowing it from yourself? No. We hear that a lot, though, don't we?
Yep. You're borrowing your own money.
Yeah.
You're not. You're borrowing the insurance company's money from their general account, and then they put a lien on your policy.
That's right. So you can go borrow up to typically 95+% of your cash surrender value out of a policy. But you're not literally taking the money out of your policy. You're borrowing it from the insurance company, mm-hmm. leveraged or liened against your cash surrender value. So that's important to understand and know as you're moving forward. You're not borrowing from yourself.
Yep. That's
BS.
Yeah, it is.
But it's a nomenclature, it's a theory and a concept that's talked about a lot, but it's important to understand how it really works. Okay? Withdrawals. The policy owner in this case can make withdrawals after the first policy year up to the available amount to withdraw. There is a $25 withdrawal fee each time they make a withdrawal, and the partial surrender charge assessed on any withdrawal that results in a specified amount decrease during a surrender period. The minimum withdrawal in this policy is $500. So these are the basics of this particular policy as we go through and we start breaking it apart today. Riders are also important. This policy only had one rider issued at its issue back in 2011, I believe it was. They had a terminal illness accelerated death benefit rider. This is basically a rider that if a doctor says you have less than 12 months to live, then usually up to 1/2 of the death benefit can be paid out to the policyholder. In this case, Transamerica is saying the maximum amount of lifetime benefit that can be accelerated for an insured is 100% of the death benefit amount or $500,000, whichever's less.
Mm-hmm.
So in this case, if it's 605, the maximum they're going to let them take out of this contract
It's 500,000.
500,000. If it was $1 million, it'd be 500,000. If it was 250,000, it'd be 250.
Yep.
So this terminal illness rider, this happened in 2008 across the board on all insurance companies. It's basically Congress went to the insurance industry and said, hey, we're going to allow you to go to your policyholders and tell them that they can take out an advance death benefit if a doctor declares that they have less than 12 months to live, and that can potentially be income tax free to use for paying medical expenses.
Mm-hmm.
Now, there's another rider that most insurance companies also offer. It's called a chronic illness rider. That rider allows for you to take typically up to 1/2 of the death benefit out and to use it up to the maximum IRS daily limits, which I think today is set at like $440 a day, to be used for long-term care. So these are great features, great benefits. That's a great benefit inside this contract. I don't have any issues with any of that. I actually don't have any issues with any of the definitions that have been laid out or the game board for which you have to play on to buy this product. I'm not going to get into the key definitions for the sake of time today. Those are important to go back and understand in your individual policy. But what I want to do now is let's go in and look at some assumptions. Let's go look at what this
Can you go to
policy
page 10.
said. Yep. So we're going to go to page 10.
And this is where Meemaw says, big print giveth, small print taketh away.
That's right.
So that's why I want to point out at the bottom, if you look at this historical rates, so if you look at how it did over a 20-year look back, you could look at the S&P 500 index change using their cap, and you'll think, oh, wow, this performed actually pretty well. The S&P, we've been on a bull run. Really, since after 2008, you can see it lost 38%. The S&P did. They got a guaranteed interest rate of 1%. But any time after that, the S&P was on a rocket ship.
Yeah.
But what I look at as the last sentence on the historical index look-back period says monthly deductions and other policy fees and charges are not taken into consideration.
Yeah, so that should be underlined. That should be highlighted. That should be like in bold print.
Because when I read that, then you look at your S&P 500 and you're like, okay, I got 7.5% quite a few times, but what was my actual yield?
Yeah, yeah. And we're going to break this down with some other software here in a few minutes. But here's the selling point of a index universal life. This is what everyone shows. Now, by the way, the agent who brought this to his client when they asked for an in-force illustration, the agent said, well, let's actually illustrate in your policy 6.25 in all years. Okay, so what I found interesting in that is that the agent wanted to illustrate something that hasn't ever occurred in the last 20 years. He wanted to illustrate 6.25 as the average rate of return that they would get in their policy before the fees, withdrawals, deductions. But what actually occurred in this policy, guys, I don't know if y'all have a highlighter back there in the studio, or if you can help me highlight this on the page. But the 20-year average that actually occurred in this policy using a current cap of 7.5% was 5.53%. And I think that's what you were pointing out earlier, Isaiah, is that if the actual index did 8.22 over that 20-year period, this did 5.53 as an overall average. But you're illustrating that it did 6.25. How do you come up with that?
And to answer and clarify some things, we get a lot of questions. Well, how does the insurance company make money? These cap rates are exactly how the insurance company makes money. If you look at 2024, they capped you at 7.5, and then the S&P did 24.01.
Yeah.
So they make that spread, and then so people are like, well, how can they guarantee one? It's exactly how they're guaranteeing one.
Yep.
So if you look at this here, and you take, they're getting 16.5% on. In year 2024, the insurance company got 16.5. They'll give you 1%, and they'll bring it down to 15.
You're saying 16.5, it says 24. What do you?
Yeah, so 7.5, 24.
Oh, you're doing the spread.
The spread.
Got it.
Insurance company collected 16.5.
Yeah.
And they're guaranteeing one because I got 16.5.
Yeah.
Here's an extra one to help you, a selling point.
Yeah.
Downturns, here's 1%.
In actuality, Isaiah, people think the insurance companies, making this fat yield in between. Insurance companies work in the margins just like investment companies do. They're getting a spread.
Yep.
That spread is usually about 1%. And so they're managing billions upon billions of dollars. And a company based out of Germany called Allianz. A lot of you out there might have some Allianz Index Universal Life. Allianz admitted assets could be over $3 trillion, give or take any day. So on the spread, 1% on $1 trillion is not a bad investment yield.
It's not a bad day.
Not a bad spread.
And yeah, that's what I mean. So 15.5 is just the illustration for this specific contract. They're doing that across multiple accounts.
Yeah. So I want you guys to look at something with me here on page 11. Coughing in my ear, man. You're killing me there.
I know, I'm sorry.
I want you to look at this illustration on page 11 of 22 here. And guys, if we can kind of highlight that, bring that up on the page. This is guaranteed projections end of year. So this policy's been in place for almost 18 years. How do I know that? It shows us his current age. An in-force illustration shows us the age at which he's attained, which is 49. So this is his 18th policy year. Now you'll see a premium outlay of $3,000. What that basically means is that $3,000 of the $3,600 he was going to pay has been paid in. So that tells me he's basically got 2 more months before his anniversary.
Yep.
Okay, so we're almost in the 18th year. His net surrender value, meaning what he could walk away with today, is $71,657. If you see that in the the fourth column over where all the numbers are at. Guys, if you want to move the cursor up there, go up, right there, 71,657. That's his cash surrender value. That's the money this policyholder could take out. And you can see he's got a $605,000 death benefit. What this policy owner said, Isaiah, was when he told me he bought it and why he bought it as a legacy play.
Yep.
He really didn't care too much about the cash surrender value. He wanted his family member, heirs, to have $605,000 in the event that he predeceases them.
Yep.
And that event should naturally happen into the future. he should predecease them. But what we can see of how we got here over 18 years, he's put in faithfully $3,600. This says his net cumulative premium was $64,605. So let's go test this in our financial model. All right, so guys, if you can, pull up the LEAP model.
It's interesting. Over the 18 years, his total gain was $7,652.
Yeah, we're going to come back to that. That's a good point to look at. So let's start age. It was what, 31?
Mm-hmm.
And let's say the end age is 49. And let's go to annual payments. We're not going to do present value yet. Annual payments, we're going to do $3,600 over that period of time. Well, that shows me $64,800 of premium. Let's go back and look at the illustration. So there we go, $64,605.
Mm-hmm.
So things are checking out there, right? Because we got $600 more that we allocated for. So it looks like things are copacetic here, right?
Yep.
Looks okay.
Mm-hmm.
Now the cash surrender value is $71,657. All right, so that's what his current market value is.
Yep.
Now let's go back, guys, and test something. Before you do, shrink the screen back down, and let's grab some numbers. Let's look at a few things. So the first thing we're going to do is we're going to go look at the index. And we're going to go repeat 2005 to 2024 in our next screen, guys. And we're going to take the S&P 500 index change using the floor and the current cap. So we know the floor is going to be 1.
Yep.
We know the current cap's going to be 7.5. So let's go test 5.53 for a minute.
Yep.
All right, so let's go to the other screen. All right, so let's go
Rate of return,
rate of return.
5.53.
Let's put 5.53 in there. So if we averaged 5.53, our cash surrender value should be $112,318. Okay? So what we want to point out here is that money is not math and math is not money. The return didn't happen that way. The return didn't get 5.53 in every year. Let's go repeat what they said happened. So let's go to historical rates, and let's go to the S&P 500. Okay, you're there, large cap. Let's go to 2005. Now, had we been in the S&P 500 and we actually got the return of the S&P 500 with $3,600 a year being deposited, we would have had $187,855 in cash surrender value before fees, before expenses.
This is also including dividends.
This includes dividends. All right, so that didn't happen. We don't get dividends in this policy, and we also didn't get all of the upside. So let's go put in what happened, guys. So 4.91, is that less than 7.5?
Yep, so they got that.
They got that.
Yep.
15 is more than 7.5.
Yep.
Let's put that in. 5.49 is less. Now, negative 37.
They got 1.
They got 1. So let's put 1 there. Market went up 26. They only get 7.5. Market went up 15. They only get 7.5.
They got 2.
They got 2. 16, 7.5. 32, 7.5. You guys get the picture here. 13.6, 7.5. 138, they got 138. 21, 7.5. 4.38,
1.
1. 31, 7.5. You getting it? We're almost there. All right. So here's the bad news. Good news, bad news. This policyholder did not lose any money, guaranteed. The contract did what it said it would do. The downside is that what should have been in this account with a net return of 5.46, you should have had $111,464. Let's go look at the illustration. So $111,464.
Net surrender value 71,657.
Net surrender value 71,657. That's a $39,807 difference. Who got the difference?
Insurance company.
Why?
Cost of insurance.
Cost of insurance. What else?
And then they got the spread and
The
fees.
spread, fees, expenses. So if we were to reverse engineer the return on his premium, let's go put that in, guys. So go back over. So it wasn't 5.46. Let's turn the historical rates off. Okay. All right, turn it back on. Turn it off. All right, go up there to the rate of return. Let's put 2% in all years. So what I'm doing now is I'm guessing, I'm backing this into that 71,000. Oh, I was pretty close, but look at that. At 2% average, Isaiah, they would have had 78,000. Let's try 1.175.
Right there.
Wow. So what really happened is that this client got a return of 1.18%.
Yep.
How excited do you get about that 18 years later?
Like watching paint dry.
And by the way, what happened to the death benefit?
Stayed level.
Stayed level. So let's do another, open up another window for me, guys. Go back inside of Leap.
I mean, that's
Open up another versatile calculator.
that's theoretically being in an investment portfolio where the investment manager is charging almost
Yeah.
4%.
So let's take 605,000. Yeah, the investment manager charged you 4. Yeah, that's a good point. Let's go back to his age 31. $18 years. Now let's go over the last 18 years. Let's do historical rates, and let's look at inflation.
So go to asset type
Asset type,
where it says large cap. Go down to inflation.
inflation USA, and let's go 2005. Okay, ladies and gentlemen, what this tells me is that in order for the rate of return to pace inflation, that death benefit would have needed to be 18 years later, $905,257 to spend like $605,000 did back in 2018. Or, I'm sorry,
2005.
So what actually ended up happening is not only did his purchasing power on his premium and the cash surrender value not perform at inflation.
His death benefit's eroding.
The death benefit is eroding each year. So another way of saying that is that the death benefit today
Lost 300,000.
lost 300,000 of its value would be the inverse of that. Does that make sense?
Yep, absolutely.
So what we see in this illustration then can't happen and didn't happen. That after fees, after expenses, even in a non-guaranteed column, you can't win. Buyer beware. Let's go back to the illustration. So if we look at what page is this over here, page 11 of 22, here's the guaranteed columns. What this tells the policyholders that if He gets out to 69 years young, 38 years later. He's going to make that last premium payment. And what we can see is that the net cash surrender value, even after all those premium payments have been paid, what's happening? The net cash surrender value is decreasing.
Yep.
So his cost of insurance is going up and up and up, while the risk of the death benefit goes to zero.
Yep.
So he's paid in $136,000. He wakes up at his 70th birthday, guaranteed.
Mm-hmm.
Death benefit's gone.
Yep.
Now I know I'm going to piss off a lot of IUL agents out there and go, Kenny, that's not going to happen. The guarantee is not going to happen. Well, we're pretty damn close,
Mm-hmm.
right?
Mm-hmm.
If we look at the track record right now, and we go look at 5.53,
And that's my argument to IUL agents. So you look over the past 20 years, we've had historical market performance, and this is still happening.
yeah. Here's the assumptive page. So let's go to page 12 and 13. If we go to page 12 and 13, this is where the agent said, well, let's actually show 6.25. Now, I'm taking the position that the agent showed 6.25 because he was afraid to show 5.53.
Yep.
5.53 would have lapsed this policy much faster than what we're going to see here on page 13. At 6.25, they're saying the policy would still lapse at 89 years old. What they're going to say to me is, hey, he's not going to make it to 89. I go, well, wait a minute. If he wasn't going to make it to 89, why would the insurance company have given him a preferred rate
At 31.
at 31? The insurance company does not want you to die. They want to have a perception that you're going to live a long time.
They want you to
because
live
might.
to 88 because you gave them $205,005 over 57 years.
Yeah. And even at 6.25, the cash surrender value is eroding.
Mm-hmm.
Why did I sign up for this? It feels like to me that it's expensive term insurance.
Yep. I was just about to say that.
And if I've got a $605,000 level death benefit, let's go back to the calculator. This is policy year 58. Policy year 58 at inflation. So let's go 31 plus 58 would be 89. So let's put him at 89. And we got to go back in history. Let's go back
58 years. To
58
prior.
years.
So that'd be 1966, maybe?
Your $605,000 death benefit to pace inflation needs to be $5.6 million.
Yep.
Now let's go look at the other thing. Let's start with present value, Cody. Let's turn now the present value to 72,846, and let's go 3,600 a year from 38 to 89.
You're getting pretty good at this, Cody.
Okay, so at inflation in my side account for the insurance company, I should have 1.3 million.
Yep.
Now let's go back and do their historical average that if we did 5.53, so turn that off and just put in 5.53 there, go back. If it was 5.53,
Should have 3 million.
they should have 3 million in here. But what is actually happening in the future is that they're showing 0 at 89 under the assumption of 6.25. So let's put in 6.25. Well, why wouldn't my death benefit and my cash surrender value be 4 million? What happened?
Fees.
Fees, expenses. mortality cost that continues to go up. Because what the insurance company says, Isaiah, is that if you got a death benefit of 605 and your cash surrender value is only 72,000, the net amount at risk is the difference between 72,000 and 605.
Mm-hmm.
So you've got about 540,000 of net amount at risk to the insurance company. They're charging you a fee for that, folks. They're charging you a mortality cost. So it's important to understand how that plays out in the future. Now, if we go to the non-guaranteed assumptions on page 14, let's go there. This is starting to look more like that illustration of 6.25, right?
Mm-hmm.
That interesting. If we got out to 89 at 6.25, they're saying the cash surrender value is $1,008,214. But let's go look at 6.25 in our illustration on the versatile calculator. 6.25 is 4,450,000. So if I got 6.25 in all years,
Mm-hmm.
what I really should have is 4,450,000. So the $3 million difference is what?
I'm sorry, I was reading this page. Say that again.
So if 6.25 with $3,600 a year premium at 6.25% gives me 4,450,418.
Mm-hmm.
But my illustration at 89 at 6.25, look here, is 1,058,637.
Again, he's taking fees.
Right. So what I propose to the people who are viewing this with us today is that the expenses and the cost of the insurance is not in your best interest to do it.
Yeah, I was just looking at the page. The reason it took me a little bit, I'm just flabbergasted at some of these numbers that they're illustrating this.
So I want to go back, and Cody, take me back to the versatile calculator here. Let's reverse engineer the return to figure out what return would I have to get in the 58th year to get $1,058,000. So let's try 4 in all years. Still too high. Try 3.25. Bingo, getting close. 3.125. We are almost there. So 3.2.
There it is.
There it is. 1,058,671 on the illustration. 1,058,149. We're really, really close. So you would get at 6.25, what you really net
At 30.
is 3.2 if you got 6.25 in all years.
Mm-hmm.
But if your 20-year look back shows 5.53, what am I supposed to believe the next 20 years is going to be like?
Yeah.
History leaves clues.
Mm-hmm.
History is not indicative of future results, but it leaves some pretty damn good clues.
Yeah, it does.
So let's go back to the historical average, 5.53. That put us at 3 million.
Mm-hmm.
But what keeps that from happening and guarantees that that will not happen is fees, cost of insurance, and the underlying expense that the insurance company tax on year after year after year. It's if the insurance company can charge you a fee,
Mm-hmm.
they will.
And it's the underlying investments that they're using too. The insurance company has expense ratios that they're passing on to the client.
That's correct. So Hopefully this illustrates for you today my frustration with index universal life as it's being used and utilized today for policyholders. You probably are asking now, well, Kenny, what would be the fix? Number one, don't buy it. Okay. Number two, if you're going to buy it, make sure you go to a competent agent who knows how to max fund. And max fund means you put in more than what's required for that underlying $605,000 death benefit. You put more in than what's required. That sounds weird, I know. Mm-hmm. But I actually wrote a white paper. And guys, what I would like to do is the white paper that I wrote, let's put a link to that where a person can download the white paper that I wrote that helps you understand how to truly design one of these policies. What I would also encourage you to do is read third-party information. There's a great white paper that Ernst & Young wrote that I'll also put that in the links so that you can read it and educate yourself on the uses of life insurance in a properly diversified wealth plan and wealth distribution plan. So today, hopefully, I helped you understand that don't always believe what you see and verify. Ronald Reagan said, trust, but verify. So hope this is good for you today.
Yep.
Isaiah, any parting thoughts?
Be careful what you buy.
Be careful what you buy. Be careful what you invest in. Life insurance is life insurance. Let investments be investments. Don't try to bring the two together in the way that an index universal life. Yeah. Do your investing outside. Use the assets from your investments to help fund your insurance to diversify risk, not increase your risk. All right. We love you guys. Hopefully that was helpful. Reach out if you'd like to learn more. Hit the like button, smash the subscribe button, or vice versa. You can smash the like button and hit the subscribe, whatever you want to do. I don't care. Just follow us and tell people about us. We love you guys. We appreciate you. Have a great weekend.
Oh, man. That product sucks.
Did we catch Isaiah at the end?
Yeah, we should leave that in there.
That would be funny to have.
Blackbox.